The stagflation of the 1970s, your grandfather's stagflation, is nowhere near the same stagflation of today. This is not the time to panic out. This is time for silver speculators to panic out, and this is the time for stackers to keep accumulating. Hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics, and boy, is it cold out there. It's cold out there every day. What is this, Miami Beach? Not hardly. All kidding aside, it's been a rough few weeks in the silver market. We're going to start with some historical perspective. This is nothing new. We're going to move to backwardation issues in the silver market. Silver has been in backwardation for almost 2 weeks. We're going to look at some records in the Nasdaq that appear to be forming as we speak. This is not a normal market in any sense, not the silver market, not the stock market, not the commodities market. Everything is out of whack. We'll see how in real terms this actually is the worst silver bear market since 1980, meaning from the August 2020 top till now is the worst silver bear market in real terms since 1980. And so if you've hung on until now, you're making history. We'll look at the Bitcoin to silver ratio, which is at a critical pivot point. And finally, Mohammed Al-Arian, one of my favorite Keynesians because he has a smidgen of common sense, says that stagflation is basically unavoidable. However, what he did not say was that the stagflation of the 1970s was under very different debt conditions than we have today. As always, this video is brought to you by Fortuna Silver Mines. And if we look at the fine print on this corporate presentation here, these are the numbers to keep in mind with silver. They're all in sustaining cost. For silver is between $14 and $19 an ounce. And where is silver now? It is above $19. Fortuna is profitable even at very low silver prices. And in my last conversation with the CEO, Jorge Ganosa, he was very clear that the company can sustain itself even at crisis low prices, just like we saw in March 2020. And then with Fortuna trading at just around $3, you're probably not going to get much better prices than this. How long they're going to last, I don't know. The only thing harder than selling high is buying low. Now this chart that I want to show you here is from Gold Charts R Us. It's Nick Laird's site. It is very good for gold and silver charting, one of the best, not the best. I just want to put things in perspective as to what is happening and how this is not unique. Nothing in the gold and silver markets that is happening now is unique. This is gold versus the Dow versus Homestake Mining, the biggest mining company at that time, from 1927 to 1939. You see the Dow Jones in black. This was the market top just before the 29 crash. Here is Black Monday or Black Thursday, October 29th. And you could see what the Dow was doing while the bubble was expanding versus what Homestake Mining was doing. It's the blue here, this tiny little line in the blue. Did it really participate much in the Dow Jones bubble at the time? No, it did not. Just like gold and silver mining stocks have not participated in this bubble either. This is normal. Now you see Homestake Mining staying steady, steady, steady as the bubble deflates here. And only after the Dow reached its low in 1932 did Homestake Mining really start to take off like crazy. Am I saying the same thing is going to happen now? No. But I am saying that the fact that gold and silver miners and gold and silver themselves have not really participated in the bubble that's been going on since March 2020 is not unique. It is not a surprise. It is normal market behavior. And the normal market behavior also is when the entire investment community finally understands that reality is now different, that there is no more bubble market, that it is dead. That is when sanity returns. People go back to real value, into real money, into real existence. The next thing I want to go into is silver has been in backwardation since May 10th. Backwardation means that the spot price for silver for immediate delivery has been trading at a premium to June silver for June delivery. First bullet point here, spot silver more expensive than June silver for 8 trading days in a row now. Backwardation is on a settlement basis, weighted bids times volume. There's a difference between settlement backwardation and last bid backwardation. Settlement is the price multiplied by the volume, and then that compared to different prices multiplied by different volumes, and then that averaged out to get an average settlement price. The reason the COMEX uses, or rather the commodity, the CME, what does that stand for? Chicago Mercantile Exchange. The reason that the CME uses settlement is they need to calculate margin requirements based on these prices, which is only fair if you volume weight it. So on a settlement basis, silver has been in backwardation for 8 trading days, almost 2 weeks. The backwardation has widened since it began. It began at 1.2 cents on May 10th, and now it is closer to 2 cents. Spot gold, not just silver, spot gold is now equivalent to June gold, so there is no backwardation yet in gold, but the market is also under pressure. The physical markets are under pressure, otherwise there wouldn't be backwardation. So let's go through these individually. The settlement prices for silver futures. You have here the settlement column, settle. This was May 12th, 20.757, and June silver 20.742. That's backwardation by about 1.5 cents. You move to May 13th, we see the same thing. Spot silver settled at 20.98. June silver settled 20.96.9. Same thing for Monday, 21.53 spot, 21.521 spot. That's 1.4 cents. And anyway, it was the same thing on Tuesday, but let's skip to the latest available data, Wednesday, May 18th. Silver settled, spot silver settled 21.53, and June settled at 21.514. That's 1.9 cents, almost 2 cents. The backwardation is widening, which means that conditions in the physical markets are getting worse. And this isn't deep backwardation or anything, but silver should never be in backwardation. And the fact that it has been in for 8 days means that there is significant stress on the retail physical markets. Let's continue. Let's move to the Nasdaq. There's something happening in the Nasdaq. It is approaching an all-time record for weekly declines. Here we have the Nasdaq since the early 1970s. I believe it was founded in the 1970s. 1973 was the year of stagflation, the oil embargo, the worst year of stagflation in the 1970s. We had a 7-week decline in the Nasdaq at the beginning of 1973 for 13%, and then a record 10-week straight decline in the Nasdaq at 23%. 23%, the stagflation week is the same what we are at now. We're at 6 weeks and 23%, so we're declining much faster than 1973. But we have 4 weeks to go to get to the time record. 1980, the year of the gold and silver peak. We had a 7-week decline of 25%, 6 weeks 1984, 12%, 6 weeks 1990, 22%, and these are all 6 weeks. The worst was the 2000 dot-com bubble burst, which was a 6 weeks decline, a 6-week decline in 2000, 28%, and then another 6-week decline going into bear market, the end of the bear market when the bears were all scared out. When the final bulls were all scared out, we had a 29% decline in 6 weeks. Now we are approaching the 6th week of 23%. We have 4 weeks to go until an all-time time record. And judging by market action today in the Nasdaq, it looks like we could make it. We have a good chance. And once a bubble stocks are deflated and hope is lost, that is when the rational investments can regain their ground and then some, and approach record territory, which I believe will happen in the gold and silver markets, especially in the silver market, especially in the silver miners, which have been clobbered over the last 2 and 3 weeks, which we have seen time and again as bubbles struggle to maintain themselves. Let's continue. In real terms, this is the silver to the CRB chart. In real purchasing power terms, you see this gray line here. This is the bear market bottom for silver in real terms at 0.0561 over here, December 2014. We are approaching that line here. It looks like we had a waterfall decline over the last 2 or 3 months. We're at 0.07. We could have bottomed here, but going from here, about a top of about 0.21 to now 0.07, the silver market has declined by 66% in terms of other commodities. This has been a serious bear market. If you have hung on until now, then congratulations. This is serious business. And almost always when you have a bear market of this severity, you end up having a rally that's equally severe. And now here's a ratio you probably not have looked at, but this looks to me to be significant as well. This is the Bitcoin to silver ratio. Here you have a high in 2017. This was the December 2017 high when Bitcoin first hit, I think, $19,900 something, almost $20,000. And then we went to the crypto winter over here. It looks like we have an exhaustion top over here. And the 2017 high is the same as support at this level, which we have just touched again. But once we break this level, there is nothing holding us back from the 200-week moving average here. And I smell a Bitcoin collapse. And as the Nasdaq goes, so does Bitcoin, because this is speculative money. This is people looking to get rich quick. Silver stackers are not looking to get rich quick. Those that are weak hands, and they have already sold. The silver stackers that are looking to preserve and grow their wealth in a rational way for generations, and yes, we understand that in a panic, we could get rich in real terms. Those investors operate in a different reality. And we know what that reality is. It is actual reality when this bubble goes away. And now there has been news from Mohammed El-Arian, who used to be in charge of PIMCO, and now he's in charge of something else. He has said and complained that there is no way out of stagflation now that the Fed has been way behind the curve. There is no avoiding it, and there is nothing to be done but keep raising interest rates and hope that the currency survives. But what Mohammed El-Arian did not mention is that the stagflation of the 1970s, your grandfather's stagflation, is nowhere near the same stagflation of today. Why? Because the stagflation in the 1970s happened specifically when the debt to GDP ratio was at extreme lows. You see this long-term chart of the debt to GDP ratio in the United States. 1970s, these were the years of stagflation. These arrows, when debt to GDP was at an all-time low following the World War II spike here. But now we're at an all-time high. Stagflation under these conditions can create a bond market implosion, whereas at these levels it cannot, because debt is sustainable down here. Even though you had stagflation, the economy could afford high interest rates because debt was so low, but now it cannot. Nobody has been in this situation before, not on a global scale. Mohammed El-Arian does not know what he's talking about, because he's never been in this situation before, and none of us have, not even the World War II generation. And so we are in extreme stretches in every market, and we are in volatile times in every market. This is not the time to panic out. This is time for silver speculators to panic out, and this is the time for stackers to keep accumulating. Reality has not changed. We've seen the same patterns in the 1920s and 30s. We've seen this pattern before of silver miners selling off and silver selling off as bubbles struggle. When the struggle is over and the dust settles, that is when real money makes its big and real return. This is Rafi, the Endgame Investor, coming at you with this week's silver report for Arcadia Economics. It's getting rough out there. Stay with us. You're going to be rewarded, and we're all in for shiny futures.